Silver just dropped from $88 to around $76, and I know what that feels like when you're watching the screen. It looks like weakness, like something just broke. But step back for a second, because what you're seeing is not the system failing, it's the system reacting. This move didn't come from collapsing demand. It came from a stronger US dollar, from a Federal Reserve holding rates at 3.5% to 3.75%, and from a market repricing the idea that rate cuts in 2026 may only happen once. That raises the cost of holding non-yielding assets like silver, and in the short term, price follows that pressure. But here's where it gets interesting. While price is moving down, the underlying structure hasn't improved. Mexico still accounts for roughly 25% of global supply under Section 301 review. Producers like Fresnillo and First Majestic are cutting output, and geopolitical stress around Iran and the Strait of Hormuz is quietly feeding inflation risk back into the system. So what you're really looking at is a market caught between two forces: policy tightening on the surface and structural tightening underneath. And when those two begin to converge, the question won't be why silver fell, but why it didn't stay there. Now here's where the story shifts, and this is the part most people are not fully pricing in. The Federal Reserve is no longer steering the system freely, it's boxed in. You have core PCE sitting around 3.1%, with the 3-month annualized pace closer to 3.5%, while GDP has slowed to roughly 0.7% and job losses are beginning to surface again. Think about that for a moment. Inflation is not cooling fast enough to justify rate cuts, yet growth is too fragile to withstand further tightening. So the FOMC holds rates at 3.5% to 3.75%, projecting maybe a single cut in 2026, and the market interprets that as strength. But beneath that surface, something more subtle is happening. As inflation edges higher, especially with energy risks tied to Iran and potential disruption in the Strait of Hormuz, real rates begin to erode, even if nominal rates stay elevated. That's the trap. The Fed can't ease aggressively, and it can't tighten without consequence. And historically, when policy enters this kind of paralysis, markets don't move in straight lines, they transition. What looks like control is often just delay. And if that dynamic continues to build, then the next phase of this cycle won't be defined by what the Fed says, but by what it can no longer do. But while the market is focused on rates and the dollar, something much quieter and far more structural is unfolding beneath the surface. Three forces are beginning to align, and none of them are being driven by short-term price action. First, the energy layer. Tensions around Iran and the Strait of Hormuz are keeping oil elevated, feeding directly into inflation expectations, and reinforcing the pressure already visible in core PCE above 3%. Second, the supply layer. The United States has initiated a Section 301 investigation into multiple economies, including Mexico, which alone produces roughly 200 million ounces of silver annually, about 25% of global mine supply. That's not a headline, that's a timeline for potential disruption. And third, the production layer. Companies like Fresnillo, 9%, and First Majestic run 11%, are cutting output, not because of price weakness, but because geology and economics are tightening simultaneously. Higher prices are no longer translating into higher supply, and when that happens, you're no longer dealing with a cyclical market, you're dealing with a constrained system. So while price moves up and down on the surface, these deeper forces continue to build pressure quietly, and they don't resolve on a chart. And this is where the picture becomes clearer, because what we're really watching is not one market, but two realities moving at different speeds. On the surface, the paper market is reacting exactly as expected. A stronger US dollar following the Federal Reserve's 3.5% 3.75% rate stance, reduced expectations for rate cuts in 2026, and rising treasury yields all push silver lower. Price drifts from $88 toward the mid-70s SEK, and it looks like weakness. But beneath that layer, the structural reality hasn't shifted at all. The market is still dealing with a 6-year supply deficit, tightening output from major producers like Fresnillo and First Majestic, and growing industrial demand tied to solar, electronics, and emerging technologies. Add to that the geopolitical pressure building around Iran and global energy flows, and you begin to see the imbalance. So what you're witnessing is not contradiction. It's timing. The market is pricing liquidity, while the system is moving on scarcity. And when those two layers diverge like this, it creates a kind of tension that doesn't resolve immediately. It builds. Because eventually, one of these realities has to adjust to the other, and that adjustment rarely happens quietly. And if you've studied history closely, this phase should feel familiar, not because the numbers are identical, but because the pattern is. In the early 1970s stagflation cycle, the market didn't immediately reward silver when the crisis began. You had an oil shock, rising inflation, weakening growth, and a Federal Reserve that couldn't respond cleanly. Very similar to today's mix of 3.1% core PCE, 0.7% GDP growth, and tightening policy constraints. And what did silver do? It didn't go straight up. It moved sideways. It confused investors. It shook out positions from 1973 to 1976. The market looked uncertain, even fragile. But once the pressure built, once real rates eroded, and confidence in the monetary system began to crack, silver didn't drift higher. It accelerated, moving from roughly $1.5 to nearly $50 by 1980, a 1,500% plus expansion. That few were positioned for. That's the part most people forget. The move doesn't begin when conditions appear perfect, it begins when the system becomes constrained. And right now, you're not looking at a clean trend. You're looking at a transition phase where price and reality are temporarily out of sync, and history suggests that phase doesn't last forever. So the real question isn't whether silver is weak right now. The real question is what happens when these forces begin to converge, because that's the phase the market hasn't fully priced yet. You have the Federal Reserve holding rates at 3.5% to 3.75%, signaling only one potential cut in 2026, keeping the dollar elevated in the short term. At the same time, oil remains volatile amid Iran tensions and Hormuz risk, feeding inflation back into the system. Now layer on top of that the Section 301 investigation into Mexico, which produces roughly 200 million ounces of silver annually, and the ongoing production constraints from Fresnillo and First Majestic. These aren't isolated variables. They're timelines moving toward each other. And when they intersect, the mechanism changes. Real rates begin to compress, supply becomes visibly constrained, and the market shifts from pricing liquidity to pricing scarcity. That's when the environment transitions from controlled movement to acceleration. Not because of one headline, but because the system can no longer balance itself the way it used to. And if that alignment begins to take shape, then what we're seeing now won't be remembered as volatility. It will be remembered as the setup. And when you bring all of this together, the conclusion becomes less about price and more about perception. Because nothing in the last few weeks has resolved the underlying imbalance. The 6-year structural deficit, estimated near 60 to 70 million ounces, hasn't disappeared. The pressure on supply, from Mexico's 200 million ounce annual output under Section 301 review to declining forecasts from Fresnillo and First Majestic, has not eased. And demand, driven by solar, electronics, and emerging sectors, hasn't slowed in any meaningful way. Yet the market is pricing silver as if none of this exists, holding it near the $76-$80 range, because the US dollar remains firm, and the Federal Reserve maintains a restrictive stance. That's the disconnect. What you're seeing in price is a reflection of policy positioning, not structural reality. And historically, when markets lean too heavily on one side of that equation, when they price liquidity and ignore scarcity, the adjustment doesn't come gradually. It comes when confidence shifts. So the question is no longer whether these forces exist. It's whether the market continues to ignore them or suddenly starts to price them all at once. So where does that leave us now? Not with certainty, but with a shift in how we interpret what we're seeing. Because the current price, hovering around 76.80, is not resolving the story. It's delaying it. The Federal Reserve's policy path, holding rates at 3.5% to 3.75%, is anchoring short-term expectations. The US dollar remains firm, and markets are reacting accordingly. But underneath that surface, the structural forces haven't paused. The 6-year supply deficit, the pressure on Mexico's 200 million ounce output under Section 301 review, and the constrained production outlook from Fresnillo and First Majestic are still moving forward. Quietly, but persistently. Add to that the unresolved energy risk tied to Iran and the Strait of Hormuz, and you begin to see a system that is not stabilizing but compressing. And compression in markets doesn't resolve through balance, it resolves through release. That release can take time, and it rarely aligns with consensus expectations. So the takeaway isn't to predict the exact timing. It's to recognize the structure forming beneath the noise, because once the market stops reacting to policy and starts reacting to constraints, the entire pricing mechanism shifts. And when that shift happens, it tends to redefine everything that came before it.